Thank you for attending once again. My name is Seewing Yee from the Yee Real Estate Network, and once again, my special guest host is Ms. Maureen McCann from Spartan Invest. Welcome, Maureen.
Thank you, Seewing. Good to be here again. Can't wait to see what you have in store for us.
Oh, absolutely. And we are going to go to a deep dive. We're going to set the benchmark and we're going to set the expectation for real estate investors who are trying to buy cash flow properties to increase their wealth. We are going to do a deep dive. We're going to do a reality check. And at the end of this, 25-minute or 30-minute video, if the investors out there refuse to acknowledge the reality of what we're trying to present, it is on you. The onus is on you either to take action or to stay in the sidelines. All right. So without further ado, let me share my screen. And we only have to have 2 slides, but within these 2 slides, there's lots to talk about. Maureen, you don't have to say anything. I'm just going to go over 2 minutes. It's something you and I have gone through this very, very important concept. It bears repeating. So real estate investors out there need to have this blueprint moving forward. So rental property is history's most proven and powerful real estate asset class. It's the world's greatest wealth building investment vehicle. And there are 4 ways you can make money. One way is cash flow / positive income. Another way is tax benefits, passive losses, depreciation, cost segregation, real estate professionals tax status, cash out refinance tax-free, 1031 tax-deferred exchange, etc. Third way investors will make money is long-term investing, over time appreciation and equity growth. And lastly, the ability to leverage your investment, which is no asset class in the history of the world can match, which is leveraging using a small portion of your risk, your down payment that is, and let the bank leverage your purchase in a way of a financing, in a way of a 30-year fixed rate mortgage, even though 7 to 8% is really not about the interest rate, right? It's all about the blueprint. We can discuss over that. So 4 ways to make money is not only about cash flow. So, and then let's segue into the core of today's message, which is we're going to use this property as a blueprint. Okay, hopefully you can see the numbers are kind of small. This property, by the way, coincidentally, Maureen, is I created this pro forma from your inventory listing of a Spartan Invest because this particular property is a typical property which our risk investors should buy. Now, before I go any further, I know you see this price point as 121,000. Let me go through the reality check. The old days for risk investors to get 1% rent to value ratio, which is 1% multiplied by the purchase price, and that should be your gross rent, are long and gone. Also, a smart real estate investors, a cash flow investors, mom and pop investors that you and I work with, Maureen, that anyway, normal people out there. So I caution you, the national media headlines, they talk about housing crash, they talk about housing prices being reduced, a whole bunch of negative headlines out there. Most of it, especially from YouTube video, I can only say most of them are garbage. So you just ignore them because it's all clickbait YouTube videos. And it just boggles my mind how those YouTube videos and national news media, they distort, they mislead, they show inaccurate information. They talk about national real estate market. There's no such thing as national real estate market. In fact, before investors take action, they need to study a specific market on a specific city, on a specific suburbs. Actually, they need to study a specific street, a specific house, a specific lot. That's how you do your research and due diligence. You don't go through a big picture. National real estate market is crashing. That is BS. Okay. Okay. And you don't buy in a cyclical market just because, San Francisco Bay Area, where I live for the past 30 something years, and San Diego, Maureen, where you live, these are cyclical markets. Yes, there are some 5 to 10% reduction. Okay, as a real estate investors, or you can buy a property in the San Francisco Bay Area for a single family home, 1,300 square foot, selling for $2 million. Yeah, I'm never kidding. So for 2 million, they got 10% decrease. Instead of selling for 2 million, you're gonna buy for 1.8 million. There's a big discount. Yeah, let's go rush and buy that investment property, single family home for $1.8 million. Guess what? Do you expect the renter gonna pay you $18,000 monthly? That's what you need, $18,000 monthly in order to cash flow on 25% down payment. San Diego, no different. The median price for San Diego price maybe depend on neighborhood. In your area, Maureen, $1 million. If an investor can buy a property there with 25% down payment, or you can expect $10,000 monthly gross rent to make cash flow on 25% down payment? No. You could have a negative cash flow of $5,000 monthly. Okay. Okay. I'm being over the top. Okay. I'm trying to prove a point. When an investor are going to buy a portfolio of cash flow investment homes, you do not go to a cyclical market. You go to a Chisaria market or a hybrid market. Most of them are located in the Midwest and in the South and Southeast. And you buy at the lowest price point relative to the rent. Okay. So, and the national media never talks about that. So any YouTube videos in real estate out there that you it's funny. I have real estate investors, they watch YouTube videos, they look at the national headline, Yahoo and CNBC or Fox News, when they talk about real estate. Do you know those information only applies to primary home buyers, owner-occupied buyers, and how much trouble they have buying property based on the high interest rate, 99.9%. So most investors, especially newbie investors, when you do your research and due diligence, you are being misguided, because all those information out there, 99.9% is for primary home buyers, and is based on a mortgage payment. Investors, when they buy an investment property, is based on the capitalization rate, is based on cash return, is based on rent to value ratio, as we see here on this pro forma. Okay. Am I making myself perfectly clear? If not, please listen to this, watch the video 10 times out there, investors out there. So whether you are experienced investors or not, whether you have purchased 3 or 4 or 5 properties in your recent past, you are misguided. Your expectation is totally out of whack. This is the reality of today's market. Look, see, the home prices in many markets in the past 2 years during the pandemic boom time have increased 50 to 100% appreciation. So the rent is lagging behind. The rental increase, although it's going through some double digit, even triple digit in certain markets, they are lagging behind. So it's very difficult to cash flow these days, even on a price home of these that we can talk about, 121 grand, cookie cutter, a 3-bedroom, 1 bath, 3-bedroom, 1.5 bath. In this case, we could dive through all the numbers. At the end of the day, if you listen to this video and if you choose to remain on the sideline until the market crash, whatever that means, well, you're in for a treat, because you may never be able to buy if you sit in the sideline thinking you can time the market. Time in the market, not timing the market. Timing the market never works. There's a human instinct to do that because there's so much fear, doom and gloom out there. So with that said, I'm done with my rant. R-A-N-T, rent, because you're too good out there. Newbies out there, newbies, your chances of purchasing your first cash flow rental property somewhere out there in the country are slim to none unless you educate yourself from the right people that can give you factual, realistic, honest information. And don't do your research based on YouTube videos out there, because every YouTube video out there is all crash, crash, crash. These are all negative headlines. Negative headlines sells. Be careful. Don't. Anyway, I'm done with my rant. So the reality is, this is a typical ideal portfolio building. Buy one or more of these properties on a consistent basis. You, a turnkey, hopefully a turnkey real estate investor, mom and pop investor, if you will, this is the number you could expect to see. It's not about the cash flow. It's not all about the lack of cash flow. And we can do a deep dive. Real estate is a multi-dimensional. We could talk about it, all right? So just be patient and listen to our video more than once. Once you get it, maybe 15, 20 times until you truly get it. If you don't, I feel sorry for you. If you want to save the sideline, that is your prerogative. All right, with that said, so tell me, Maureen, why does this property with these numbers is ideal, sort of a blueprint purchase criteria every investor should look into?
Here's my thoughts, Seewing. I love your rant, by the way, because sometimes you got to talk a little tough love to to push through all of the noise, because of what you and I, where we come from, is just really wanting best for investors. And I know there's a lot of uncertainty, a lot of fear that is generated in the market, and then people tend to get paralyzed and then don't take any action. So this is what you and I have decades now of experience in knowing, is that real estate has been the only vehicle that I know, and I think that that leads to long-term wealth building, whether the interest rates are high or low, whether the prices go higher or lower. The multiple ways that real estate pays us as investors, those fundamentals do not change, whether there are fluctuations in the marketplace. So I think that is something important to note. And I think I had said in a previous video, one of the properties that I had put under contract years ago had an interest rate of 9.9%. It still cash flows, so it still made sense for me, so I still did it. And now that property, let's fast forward 13 years later, is paid off in full. Actually, it's two of them, and they're generating over $2,200 a month, just feeding my retirement account. So had I let fear, sideline me 13 years ago, I wouldn't be able to say that today, right? And it's just feeding my retirement and building my retirement account up, which is a beautiful thing. So this is why you and I have such a purpose and a passion, and sometimes tough love is needed, some tough talk is needed to really penetrate the defensive wall, the fearful wall that is up with our investors. And and I'll state it out here too, right? Many investors that are listening are like, oh, you guys are just trying to sell something. Yeah, we actually sell product that can help build your wealth long term and get you through a time that is very unique at this particular moment. And you either can do something or do nothing. We are the camp of do something, which is invest in hard assets. Whichever hard asset you choose is awesome, but just don't be caught in the tale of two cities, where you've got the one city that is a group of investors that are actually continuing to see the opportunity and to invest for their family's wealth and their financial future. And then you have the other city, the other tale of the other city, which is investors who are just going, I'm just going to sit on the sideline and wait and see. And I'm like, well, you can take the wait and see approach. There's going to be a large percentage of you that are going to do that. And there is maybe you don't have maybe the fear of missing out isn't that large of a driver for you. But the ones that understand the fundamentals, the ones that understand that this is a great time to invest in real estate, regardless of the interest rates as they rise, there are ways that you can maximize your return on that property from the other 4 to 5 ways that real estate pays you. Once you get that, you can't unlearn it.
Maureen, before you dive into the numbers, because this is your property in your website, I know you have before you do a deep dive, I want to share with you the metrics. I'm not going to go over the numerical formulas. There's a separate 3 videos that I've done in the past. You can look into my YouTube channel, you will find it. And the thing is cash on cash return, debt to coverage ratio, and then rent to value ratio. If you look at the numbers, again, we're not going to go over it. We're going to go the calculation, because the debt to value ratio, I think, is around 0.08%. That really, when investors when you finish doing your due diligence and research, these numeric formulas make sense. We can control what we can control. So the debt value ratio is anywhere from 0.07 to 1% rent to value ratio, in which this blueprint property meets that criteria. Then what else? Then the cash on cash return, 5, 6, 7%. That makes sense. Then the capitalization rate. If the capitalization rate, the cap rate is around 5% or higher, those are good benchmarks. So all the numerical formulas meet the benchmark. The problem, you're not getting that high of cash flow because of the mortgage interest rate have risen. Today, for owner-occupied buyer is around 7%, give or take. But for investors, you're paying a higher interest rate. You are paying, as of today, October 26, around 7.75% mortgage interest rate for investors. There are some flexibility around that. We're not going to go over the different loan options. That's another video. But that's what you can do, and you can still cash flow even with a allegedly very high interest rate. Is when you're buying a property, you're not buying based on your monthly payment like an owner-occupied buyers or have to go through. You're buying based on the numerical formulas I just shared with you. At the end of the day, if you look at all the numbers, okay, I'm speaking too much. I know, Maureen, you can have your chance, but this property, don't focus on the whatever cash flow, monthly net cash flow you're seeing on the upper right-hand corner, which is a little bit less than $100. That's just one small component, and we can go over that. Cash flow is only one of the 4 components that makes out a multi-dimensional aspect of an investment property. So without further ado, can you, Maureen, go and do a deep dive on this numerical numbers, the market price, the down payment, the debt service on the lower left-hand corner, and then right-hand corner at 25% down based on 7.75% interest rate. At the end of the day, in the upper right-hand corner, you will see a break-even or slight positive cash flow. This is the benchmark. This is the expectation for moving forward. If you guys do not accept this reality, then you're going to have to make a decision to take action or not to take action and suffer the long-term consequences of going through the variable decision-making process. Okay.
And one other key difference, Seewing, that when you were going on your rant that I wanted to chime in, but you were on such a roll that I didn't want to stop you, right, is the difference between all of the, a lot of the marketing that is done, the videos that are done on social media, those are directed at the primary homeowner, whereas that primary homeowner is responsible for the taxes, the insurance, the mortgage, the maintenance. They're responsible for all of that. There is no, unlike the investor buying the property, they leverage or arbitrage all of those expenses to the renter. So it's not like they're on the hook for all of those things each month, maybe just a month or two if there's vacancy, or a week or two, or whatever the time frame is. But they basically leverage bank money to buy an asset that increases along with inflation and value. Rents increase right alongside with inflation. We're underbuilt. There's a demand for rental properties. And this is a great vehicle for investors who are wondering, where do I put my capital right now? Because I'm afraid to put it in the market. I don't want to put it in the bond market. I'm afraid to put it in crypto because it's on the way down. You know, maybe some of you are even saying, I'm afraid to put it in real estate because there's going to be this big crash. Well, it doesn't, this is not 2008, simply because underwriting has been very, very tight since then. The number of property owners that have lots of equity in their homes right now is higher than it's ever been. So if there is a challenging situation, they can exit and still walk away with some money. So there's not this huge foreclosure wave that's coming either, like similar to 2008. So if you look at just how underbuilt we are, and if you really look at and just think about it this way, we're underbuilt, there's undersupplied, there's a huge housing gap that exists today by 3.9 million units based from according to US economists. So, and we've got properties that are the production of new builds is being slowed down from builder confidence sentiment as it's dropping, because they're like, hey, I don't want to keep building if I'm questioning if I can even sell what I've already built or that's under construction at the moment. And so the housing gap is just going to get wider. And with people not being able to purchase, right, because it's out of their reach now from a home affordability standpoint, and from making the monthly payment because there's upward pressure on the interest rate, then that forces more people into the rental market. So if you are really, if you subscribe to that thought, if you actually believe that thought, just like I do, then it then makes really good financial investment sense to be the landlord offering the property to an upsurge in rental demand, because housing affordability at this particular moment is out of the reach of many Americans, millions of them. So they need a place to live. So be the landlord, be the hero, be the person that has the property to rent to that particular family until their circumstances change, right? But until then, I think we're kind of in this for a while, right? So what are you going to do with your capital that's sitting in an interest-bearing account? Let's call it 3%. That's the highest I've seen advertised now, with some banks saying, give us your money for 12 or 18 months and we'll give you 3% on that. But guess what? Inflation, CPI, which, you know, is, I think it's a bogus number, but let's just go with it because it's what's reported, right? So if you put $200,000 in a CD, that's paying you 3% for 12 months, and you could put that same amount of money in multiple hard assets like single families, then you are earning not only on the appreciation piece, the equity accrual from the loan pay down or principal pay down from your renter. You've got the cash flow. It may not be as high as you'd like it to be, but it's still cash flowing after all expenses are paid. You get to write off the depreciation every single year on your tax schedule. And it's an exceptionally great, not even hedge, it's an exceptionally good partner with inflation as rent and property values continue to rise during that same time. So your 3% sitting in a CD today, if we go with the CPI number that reported of 8.3%, then your 3% is still negative compounding 5%. So you're not winning. You're just sitting there losing money, but that might make you feel safe. And maybe that's what you want to do. Then you know what, go right ahead and do it. But just know that the money that you have invested in that 3% CD today is not outpacing inflation. You're not building wealth. You're just not. So if you are a wealth builder and you actually want to do something to create financial freedom for your family and yourself in the coming years, find a vehicle that is going to produce a yield for you that is greater than inflation, that will build your wealth faster than a CD or some other investment that is not outpacing inflation. And when you can find an asset class that pays you in 5 ways, even if it doesn't get you the $400 a month in cash flow that you want, maybe it's $100, it still works. And this is why Seewing and I are so adamant and forceful with getting this message through to you, because it matters to your long-term survivability and financial security when you actually ignore all of the noise that's being generated in the primary homeowner world and redirect your focus on the investor world and know and understand the fundamentals and use that logic, that basis for your sound financial decision making at this time. That is what we're trying to get through to you. This is what you need to hear. And you really need to, if we want to look at the numbers, we can do that, because, you know, maybe you've got to come in with 30% down now instead of 20%, but it's still putting more equity into your property where you then can capture all the other ways that real estate pays you. And when you put more down, your monthly cash flow goes up. And when there is a moment in the future where you can refinance, if it makes sense to get your 8% down to 4%, if we get there again, then you position yourself, you've got the asset, you've held on to it for the number of years, starting from today. If you bought today, let's say you refinance 3 years from now, well, you've captured the equity accrual for those 3 years. You've captured the capital appreciation or the value of the increase in the home value for that 3-year period. You've captured the cash flow for that 3-year period. You captured the depreciation for that same 3-year period. Whereas if you didn't do that, then you've lost all of those opportunities to position yourself to be better from a financial standpoint. And that is what you guys really have to understand and get and know. Get off the 8%, you know, or the 7.75% interest rate. If the deal still cash flows and you earn in the other ways, then there is no logical reason for you not to do this today.
Maureen, I sense a sense of bluntness and directness on your part. I sense the frustration and the passion with the way you just, and energy that you provided. Just like me, you know, we are passionate about what we're doing. We're putting the honest, direct, factual message out there. And, you know, we are motivating, encouraging, inspiring real estate investors, mom and pop people out there that want to achieve financial freedom. This is the way to go. So, we only have a few minutes left. You know, I'm not asking Maureen to go over this pro forma. I'm just sharing this with you. If you target the right market, a market that are very affordable for investor, okay, the entry-level type of single-family homes, and sprinkle some duplexes in a way. If you buy in the tertiary market or the hybrid market, you know, south and southeast mainly, right? If during your research, if you find a market, a region, a neighborhood, a street in a corner, whatever, that have a good rental market, that have a good rents, that have a good job growth and population growth, diversified economy, good business climate, good place to live, and you can cash flow with 25 to 35% down payment. I mean, that's what you should ask for. So, and the criteria is, although we're showing this very small, low price cookie cutter $121,000 property, the cutoff point is around $350,000. Single family home, anywhere from, you know, $60,000 to $350,000. Those are the metrics if you want to buy a cash flow properties, because $350,000 you can get $2,400 rent, and at 35% down payment, even at 7.75% investor interest rate, you can still cash flow a little bit. So with even though we presented this 1K and it cash flow just a little bit, we are really presenting a price point anywhere from 60 grand to $350,000 for single family home in affordable market with and this number you can plug into any property within this price range as long as you buy in a good market, South and Southeast and Midwest, right? Surround yourself with a good team you trust. They can provide this property for you. They can hopefully with a professional property management, which we have. So yeah, so we only have 2 minutes, Maureen. So is there any numbers on this pro forma that you want to slightly touch on before we'll conclude this video?
Just one, Seewing, because I would pose this question to anyone listening who is either bought either a primary residence themselves, or if they have a portfolio or even just one single family rental property. My question to them would be this: 10 years from now, is this same property going to be valued at $121,000 or more, most likely? Right? I think we all know the answer to that question.
Furthermore, 10 years from now, are you still getting this $50 to $100 monthly net cash flow or not? What's your answer?
The answer is more, because you've got rent inflation over that same 10-year period, but you've got it on a fixed rate, over a fixed rate monthly payment. So the fixed monthly payment never changes, but the rent escalation over that same time period does. Same thing with the equity accrual, as the renter is paying down that principal year after year for us as investors. And then of course you get the tax write-offs for the depreciation through that 10-year period. So this is not a decision that you make. You don't go, I'm going to buy this property because it's going to provide this to me in 1 year. You have to look at 5, 10 years, 15 years from now. What is this hard asset going to do for you? Is it the most ideal time to invest? Maybe not in your mind, because you're going, well, I want the 2 to 3% interest rate. That has passed. That is in the past. We're not going back to that. I don't see any time soon. So you still have to you have to make the financial decisions that are going to project you and keep you on a road that will lead you to financial security, is what I would say.
Maureen, great comment. Let me share with you a couple of more things what I need to say. Right now, regardless of what you hear out there with all the negative headlines, right now we are historic low supply of inventory. And we have moderate to high demand. Temporarily, the demand has went down because of the 7% interest rate, mortgage rate. But once those interest rates come down, the next few years, it's gonna come down, right? Eventually it's gonna come down. We don't know when. Then you can be fine, right? And I spoke with a number of investors lately, especially in the past 6 months when the interest rate spiked. And some of my investors, they tell me, "Oh, I'm gonna wait because I see the market is subsiding. I see some massive reduction in prices." Then I ask, then what are you gonna do? Are you gonna buy a 20% discount on a home in Las Vegas that's cost $500,000, but the rent is only $2,000? Even if you get 20% discount, or in California, I mean, you cannot cash flow. Those are the wrong markets, right? I mean, if our markets, your markets, Maureen, Spartan Invest, Alabama, Georgia, Tennessee, those prices you're promoting, they're not gonna come down. My markets, I'm promoting Central Florida, Southwest Florida, Central Texas, and Buffalo, and New York. The prices are not going down. Okay, so if you're gonna wait, expect to get a 50 cents on a dollar, expect the market gonna crash at 80% reduction in prices, you are delusional. Delusional. It ain't happening.
That was 2008. That is not today.
Right. This is a new normal for real estate investors. This is a total different ball game. Are you gonna play the game the way we just shared with you, or are you gonna stay in the sideline and
spectate
and time the market? In fact, most of you are staying in the sideline, timing the market, I'm venture to say you will never invest. It's never going to be the right time for you. You're going to be analysis paralysis. And I've seen cases. I work with 1,000 investors over the past more than 20 years. And Maureen, you have over the past decade. You see people, oh, I'm going to wait until it's the right time to buy. Those people that say that 10 years ago, they have not.
Yeah.
They have not done nothing. Those people waiting right now, 99% of you waiting on the sideline, waiting for a better deal to come down the pipe. You're not going to take action. That's the human nature. That's a mindset. So I have concluded that that's all I have to say. There's nothing more. We have given you so much factual, scientific data, right? And don't get emotional about it. Don't think negatively. Don't think doom and gloom. It's not doom and gloom. Low supply, record low inventory supply, still high demand, equal high housing prices will increase, regardless of what you hear out there right now. Oh, crashing, this market crashing, that market crashing. Those are garbage information provided by those garbage YouTubers and those anyway.
It's a tremendous opportunity right now. Whether you take it or not, that is up to you. We're just trying to point out to you that it is a tremendous opportunity and it always has been. I mean, it doesn't matter if we're low interest rates, high interest rate, the opportunity to invest in a hard asset that will build your family wealth has been tried and true for centuries through real estate. So you either, do something about it or don't. We hope you do, and we hope that you reach out to us and ask us any other questions that you have about this current market and how real estate can help you build wealth for your family.
Yep, absolutely. With that said, as we conclude this presentation, Maureen, I know I'm going to put your contact information, but verbally tell people how can people contact you to look into your inventory of cash flow homes in your market.
We just started listing our inventory on our website. So just go to spartaninvest.com and look for properties. You can find us there.
Yes, that's simple. Thank you so much for your time, Maureen, and thank you all of you. That hopefully we are very passionate and we believe what we're doing, and so we just want you guys do well out there. That's all we want. We want you to be happy. In fact, don't worry, buy happy.
You just make that up. That was good. That was
That's
good.
right. Don't worry, buy happy.
You're adorable, Seewing.
Thank you so much. Anyway, we're done. Thank you so much. Have a nice day. See you on the next video. Bye-bye.
Bye-bye.